So, gold just shattered another all-time high, blowing past $4,400 an ounce in silver. Silver's marching towards $70 with its best year ever. But here's the thing. Today we're diving into why this isn't just another rally. We're talking about Italy making moves on its gold reserves that have the ECB absolutely furious. We're looking at the BRICS nations launching something that could fundamentally reshape how global trade actually works. And we're unpacking predictions that might sound insane until you hear the logic behind them. $10,000 gold by 2026, $200 silver. And I'm saving the most interesting part, the real mechanics of what happens when the paper markets can't deliver physical metal, for the very end of this episode. Now look, before we get into this, I need to ask you something. If you find value in what we do here, if you appreciate that we're out here doing the hard work, researching, fact-checking, making sure we're not just regurgitating whatever narrative Bloomberg wants to push that day, then please hit that like button, hit subscribe, and if you're able, if you want to support truly independent journalism, consider sponsoring this channel or using the YouTube Super Thanks feature. Because here's the reality, we're not beholden to advertisers, we're not reading from corporate scripts, we're doing this the old-fashioned way, chasing facts wherever they lead. And that takes time, that takes resources, that takes commitment. So if you value that, if you want to see more of it, your support genuinely makes this possible. And trust me, you're going to want to watch until the end. Because what I'm going to show you about the physical delivery squeeze, that's where things get absolutely wild. Let me tell you what's really happening here, because the mainstream narrative, the one you'll see on Bloomberg or CNBC, they'll tell you it's about Fed rate cuts. They'll say it's monetary policy, and that's just lazy reporting. The Fed is practically irrelevant to what's driving gold right now. And I know that sounds bold, but hear me out. There are four fundamental forces at work here. And once you understand them, once you see how they're all converging at the same moment, you'll understand why we're not looking at a bubble. We're looking at a repricing. First, central banks. And this is crucial. From 1970 to 2010, central banks were net sellers of gold. They were getting rid of it, treating it like a relic. But in 2010, something shifted. They became net buyers, and not just net buyers, but increasingly aggressive buyers. Russia, China, Turkey, India, the list keeps growing. These aren't retail investors chasing momentum. These are institutions with trillion-dollar balance sheets making strategic decisions about the future of money. And here's what's interesting. Central banks don't chase price. They put a floor under it. Russia was transparent about this. They just put in standing orders, 10 tons a month, whatever the market would give them without disrupting things. But if they saw a dip, they'd step in. So for investors, this is actually beautiful. You get all the upside, but the downside is somewhat limited because you've got these massive institutions backstopping the market. That's number one. Number two, and this is just basic economics, supply has been flat for 7 years. Around 4,000 metric tons annually, give or take. I'm not saying we've hit peak gold. I'm not saying there are no more mines out there, but they're getting harder to find, more expensive to operate, and the easy deposits, those are long gone. Meanwhile, demand keeps climbing. When demand goes up and supply stays flat, price goes up. That's not speculation, that's math. But here's where it gets really interesting, and this is something most people completely miss. Institutional investors, sovereign wealth funds, big mutual funds, pension funds, their allocation to gold is tiny. We're talking 1 to 2%. You might think it's 5 or 10%. It's not. It's 1 to 2%. Now just imagine, they decide to go from 2% to 3%. That's not even a dramatic move, right? That's a modest rebalancing. But the amount of dollars involved is so staggering that there literally isn't enough gold available at current prices to satisfy that demand. The price would have to shoot higher just to make the market function. And that process, that's starting right now. And the fourth driver, this is the one that really explains why we're seeing acceleration, financial warfare. We're in the 21st century. We still have bombs and missiles, sure, but a lot of modern warfare is economic. It's sanctions, it's asset freezes, it's using the financial system as a weapon. And everyone watched what happened with Russia in 2022. Europe, with help from the US, froze $300 billion in Russian treasury securities. Not temporarily froze, they actually took steps to steal them, to use them as collateral for loans to Ukraine. Think about that for a second. Russia bought those securities legally, they made the money from oil sales, they put them in a custodian in Brussels called Euroclear, and then they got seized. Now, if you're Saudi Arabia, if you're Japan, if you're Taiwan, if you're Brazil, any country holding large amounts of US treasuries, you're watching that and thinking, what if I'm next? What if there's some policy dispute? What if I end up on the wrong side of Washington's priorities? Maybe I should diversify into something that can't be frozen, can't be seized, can't be confiscated by someone else's government. And that something is gold. So they're not dumping treasuries. That narrative is overblown. But as new reserves come in, they're allocating more to gold. These are fundamental structural shifts that aren't going away. Now, silver, let me talk about silver for a moment, because it's been absolutely explosive. And people ask, is it just following gold? Is it China driving this? What's really happening? Silver is definitely coming along for the ride. Gold leads and silver follows, but there's something else going on beneath the surface. There have been supply disruptions in the London market, and this gets to something really important about how these markets actually work. There's a woman named Blythe Masters. She used to run commodities trading for JP Morgan. And she made this comment about gold, but it applies equally to silver. She said, gold never settles. And what she meant was, if you look at all the paper transactions, futures, forwards, options, unallocated accounts with banks, all of it, the amount of paper gold and silver relative to actual physical supply is probably 100 to 1, maybe more. As long as everyone's just rolling contracts over, not demanding delivery, the market functions fine. But the minute some segment says, no, give me the physical metal, I want delivery, all of a sudden the exchanges and the warehouses are scrambling because they don't have anywhere near that much metal. They can never keep up with the paper side is way too big. So what you're seeing now is dynamics of a short squeeze playing out in real time. People are demanding physical, and the system is straining to deliver. That's driving silver's move. And when you think about it, if gold's going where many people expect, and we'll get to those numbers in a minute, silver has to move too. There's no scenario where gold goes to $5,000 or $10,000 and silver just sits still. Now, I want to talk about something that's been making headlines in my world, something close to my heart, actually. Italy. There's been drama, serious drama, with lawmakers from Giorgia Meloni's party pushing through an amendment declaring that the Bank of Italy's gold reserves, and Italy has the third largest gold reserves in the world, by the way, declaring that those reserves belong to the Italian people. And the ECB, the European Central Bank, they are furious about this. They've been pushing back hard. So what's really going on here? Is this just populist theater, or is this something more fundamental? And I think it's both. Honestly, Meloni is a populist, she's a nationalist, she's appealing to that sentiment, but there's a real question underneath it all. Who owns Italy's gold? Because when a central bank owns it, and that central bank is subordinate to the ECB, then you have to ask who really controls it. Is it Italy's gold, or is it the ECB's gold? And this isn't just theoretical. Mario Draghi, Mario Draghi, he was head of the ECB, but before that he was head of the Bank of Italy. And about 10 years ago, he gave a speech at Harvard. Someone asked him about Italy's gold, and he said, I never sold 1 ounce because I considered it a hedge against the dollar. Think about that. Here's this full globalist, impeccable credentials, and even he understood that gold is a dollar hedge. Even the globalists get it. But there's something else happening at the same time, and this is really telling. One by one, central banks across Europe are calling up the Federal Reserve Bank of New York and asking for their gold back. Germany did it. The Netherlands did it. Italy's doing it, because a huge portion of official gold, maybe 10 or 20% of all the official gold in the world, about 6,000 metric tons, sits in a vault at the New York Fed. And these countries are saying, send it home. We want it back. Russia was smart. They never put theirs in New York to begin with. But now there's essentially a run on the Fed when it comes to gold. And when that gold gets home, back to Rome or Berlin or Amsterdam, then the question becomes, who owns it? Is it the government? Is it the people? Is it still somehow under ECB control? And that's exactly what this fight is about. It's a tug of war between globalist institutions like the ECB and national sovereignty, and ultimately the people. And I think Meloni's going to win this one, because it's part of a larger wave, this nationalist wave that's sweeping across not just Italy, but across Europe. You've probably seen headlines about Europe preparing for a new gold standard. And look, I'm skeptical of that. The likelihood of the EU dismantling seems greater to me than all these countries suddenly working together toward a gold standard. But let's think through the mechanics. If you want a gold standard, you need gold. These countries, Germany, Italy, France, they have substantial reserves, second, third, and fourth largest in the world after the US officially. But they also have enormous money supplies. You need some ratio of gold to money supply to maintain a credible gold standard. Historically, 20 to 40% has been enough. The UK in the 19th century ran about 20%. The US in the first half of the 20th century was around 40%. We lowered it to 25%, and now we're down around 7 or 8%. So you'd need a lot more gold than these countries currently have. And given that Germany is committing economic suicide, France isn't far behind. I just don't see them pulling together for something like that. The EU is more likely to fracture than to unite around a gold standard. And speaking of fracturing, I was just in Slovenia a few weeks ago, lecturing on gold and economics. And I told them, look, here's what you should do. Quit the EU. Quit NATO, go back to your own currency, set up a currency board, the kind Steve Hanke recommends, and split your reserves, half in gold, half in dollars. Because Slovenia is a small country, only about 2 million people, but they've got natural resources, nuclear power, they're a transshipment point, highly educated workforce. The EU is dragging them down. Germany is destroying its own economy. I bought a German car recently, made in Germany, but when I checked the specs, the engine was made in Hungary. And I thought, why would a German auto manufacturer outsource engines to Hungary? And the answer is energy costs. Hungary still gets natural gas from Russia. Germany blew up the Nord Stream pipeline, so now they're relying on windmills and destroying their industrial base in the process. But here's what might actually be realistic, and this is something I've been watching closely, and I want to know if you've heard about this. The BRICS nations just launched a pilot for something called the unit. It's reportedly a trade settlement instrument, 40% backed by physical gold, 60% by a basket of BRICS currencies built on blockchain technology to bypass the dollar. Now, I've been hearing warnings about a BRICS gold-linked system for years, so how big a deal is this? How realistic is it? Okay, so here's the truth. The unit, as far as I can tell, it might be real, but it's not official BRICS policy. It looks like some crypto promoter is behind it. Maybe you can go buy one if you want, but that's not the official BRICS currency. But, and this is important, the BRICS nations are doing something significant. They're not launching a common currency, but they have built a BRICS payment system. The infrastructure, the fiber optic connections, the high-speed digital settlement and clearance, the message traffic, essentially their own version of SWIFT. They've built all of that, and they're rolling it out now. They're leaving SWIFT behind, leaving FedWire behind, leaving the New York clearinghouse behind, and building their own parallel system. Now, this is communication infrastructure, it's ledgers, it's settlement, could be blockchain-based. Blockchain's been around since the 80s, so that doesn't make it crypto per se. But they've built it, and now you can have bilateral trade between any of the, 11 or 12 BRICS members now, and there's a waiting list of 17 more countries trying to join. This thing is growing fast. So Russia buys manufactured goods and semiconductors from China. China buys oil and natural gas from Russia. Russia pays in yuan. China pays in rubles, but those balances build up at the central banks. They have to be settled periodically. Russia ends up with too many yuan. China ends up with too many rubles. So how do you settle that? And here's the answer. Here's what people miss. They do have a common currency. It's gold, not the unit, not some new BRICS cryptocurrency, gold, because gold can be converted into dollars in real time if needed. Everyone agrees gold is money good. It's easy to value based on global markets. So they settle on a net basis, not gross. They don't do it in real time, maybe quarterly or twice a year. And when the balance favors one side, they just say, here's a certain amount of gold, done. When people ask, when is the BRICS currency coming? The answer is, it's already here. It's called gold. Now, let me get to the numbers everyone wants to hear about, because this is where things get really interesting. There's been serious talk about gold hitting $5,000 by the end of 2026. But here's the thing. We might hit that before we even get there. And honestly, $10,000 gold by the end of 2026 wouldn't surprise me at all, not even a little bit. And I know that sounds insane, but let me explain the math, because it's actually simpler than you think. People get anchored on $1,000 increments. They think, okay, gold goes up $1,000. I make X amount of money. It goes up another 1,000. I make the same amount. And that's true in absolute terms. But what they forget is that each $1,000 milestone is easier than the one before, because you're working off a higher base and it's a smaller percentage. Concrete example, when gold goes from $3,000 to $4,000, that's a 33% gain. But when it goes from $9,000 to $10,000, that's only 11%. That's like a good week the way gold's been moving lately. So people think it took forever to get from $3,000 to $4,000, therefore it's going to take forever to get to $10,000, but that's not how it works. It'll make its way to 5 or 6, sure, but then it's going to go 7, 8, 9, 10 really quickly. And if gold goes there, you're looking at $200 silver. That's not even a stretch. There's no fixed gold to silver ratio, despite what some people claim. That 16-to-1 thing was just 19th century lobbying by silver miners. But there's no way gold goes to 5 or 10,000 and silver doesn't move substantially too. So $200 silver would be completely in line with $10,000 gold. And silver is finally showing its true price. It feels like it's breaking free of whatever has been holding it back. Silver has always lagged behind gold. Gold leads the way, but now the lag has caught up and silver's taken on a life of its own. It's shining through. But here's the question everyone asks, and I want to address this directly before we wrap up. People say, I missed the rally, gold was at $700 or $1,200 or $1,300 and I didn't buy, and now it's at $4,500, I've missed it. And my answer is, you missed $3,000 of gains. That's true, but you have not missed the rally. It's going to 5,000, then 10,000 sooner than people realize. It's not too late to get in. Even if you're buying gold at $4,500, if it goes to $10,000, you still double your money. And it could go a lot higher than that. You don't have to sit here and listen to me make $20,000 forecasts. Though honestly, is that insight? Yeah. It is. So you're a little late to the party, maybe. But the party is just getting started and it's going to last a long time. And people are going to wish they bought at $4,500 the same way they now wish they bought at $3,000. So here we are. Gold shattering records, silver having its best year ever, Italy fighting for control of its own gold reserves, BRICS nations building parallel financial infrastructure, and predictions that sound crazy until you understand the fundamentals driving them. Central banks buying at record levels, supply staying flat while demand climbs, institutional investors starting to dip their toes in, financial warfare making every country with dollar reserves nervous, and paper markets stretched so thin that physical delivery demands are causing actual strain in the system. The message is clear. This isn't a bubble. This is a repricing. This is the global financial system realizing that maybe, just maybe, the old assumptions about fiat currency and dollar dominance need to be reconsidered. And gold, physical gold that can't be printed, can't be frozen, can't be seized. Gold is the beneficiary of that reconsideration. So if you found this valuable, if this helped you understand what's really happening beneath the surface of these markets, do me a favor. Hit that like button, hit subscribe, and if you're able, if you want to support what we're doing here, consider sponsoring this channel or using super thanks. Because this is how independent journalism survives. This is how we keep doing the research, the fact-checking, the analysis that cuts through whatever narrative the mainstream wants to push that day. We're in this together, and your support makes it possible. Look, before you go, I want to say something from the heart. If you found value in what we covered today, if this helped you see past the headlines and understand what's really happening in these markets, then please take a moment to hit that like button and subscribe to the channel. It genuinely helps more people find this content. And if you're in a position to do so, if you believe in what we're building here, consider becoming a sponsor or using the Super Thanks feature. I'm not going to pretend this work is easy. Every episode requires hours of research, cross-referencing sources, verifying facts, making sure we're not just repeating whatever narrative is convenient or popular. In a world drowning in misinformation and fake news, that fact-checking process, that commitment to accuracy, it takes real time and real resources. But here's the thing. I don't see this as me asking for help. I see this as a partnership. You value independent journalism that isn't beholden to corporate interests or advertisers, and I'm committed to delivering exactly that. Together, we're building something that matters. Also, drop a comment below. Tell me what you think. Share your perspective. Let's keep this conversation going. This community, that's what makes all of this worthwhile. Thank you for watching. Thank you for being here. And thank you for being part of this journey. It means more than you know.